Hey folks, I've been working on a big project which has generated a ton of video, and I'm still working on getting all of those videos compiled in a relatively good viewable format. When I get that finished, I'm going to link to that right up here. Quick preview of that project, a complete remodel of our bathroom, and I've got video from start to finish. I'll show you how I did it, including pouring the countertops. You're not going to want to miss this. But in the meantime, I had a specific request earlier this week to get out a video on dynamic banking and infinite banking and how we can use those together. And specifically, what I'm going to go over is how I do it with my finances. So what we're going to go over today is dynamic banking and infinite banking and how those work together to maximize your income. So there's different ways to approach it also, based on whether your infinite banking policy is smaller or larger than your line of credit that you have access to. And it's really neat to see the best ways to make this work. And I'm going to go over that in numbers right after this. So stick around. Welcome to Oregon Cash Flow Pro, where we're here to help you take control of your finances, maximize your cash flow, and reach financial freedom. Okay, I'm back. Got my hair cut, ready to go. Let's get into this. So the topic is using dynamic banking with your line of credit in order to fund your infinite banking policy. This is a great way to maximize your income and increase your cash flow. But there's slightly different ways to do it depending on if your policy premium is greater than or less than your line of credit. Okay, so first of all, if none of this is making sense to you, maybe you haven't seen what dynamic banking is all about yet, you can check out this video right here. And I will also link to a video on infinite banking so that you can be all caught up. So I'm not going to get into much on dynamic banking and infinite banking outside of the design of the policies here. So be sure to watch those videos and they'll get you all caught up and you'll understand what we're talking about here. So here's the basics of it. If your policy premium is less than your credit limit or the same as your credit limit on your line of credit, then you'll want to make the full annual payment using your line of credit. And it will look like this. Line of credit, you're going to pull money out of that. You're going to put it into your infinite bank, paying the premium, and then you're going to borrow from the infinite bank and pay back that line of credit, freeing up that full line of credit. So the only place you're going to end up with a loan is right here in your infinite bank policy. And the reason we want to do that is because typically the loan interest is lower and you are not obligated to pay it back on any specific time period. So there's no minimum payments or anything like that, which you do have in your line of credit. Now, we all know with dynamic banking, the way we utilize our line of credit, the minimum payments don't matter anyways. So really the difference here between whether we are borrowing from the infinite bank policy or whether we continue to just borrow from the line of credit has to do with where's the lowest interest rate that we're going to be charged. So if your premium is greater than your credit limit, then you want to make as large a premium payment as possible using your line of credit, then borrow from your policy as soon as you have cash value available, which is usually within 3 to 10 days, pay back your line of credit with as much cash value as you just generated, and then immediately make another chunk from your line of credit onto your policy. Borrow again, and you're going to repeat this until your policy is max overfunded for the year. And at that point, you're going to proceed to practice dynamic banking with your line of credit to pay off the line of credit, and then you want to start working on your policy loan. So to reiterate, you have your line of credit, you're going to borrow from that, put that money into paying your premium on your infinite bank, borrow to pay down the line of credit. You're not going to be able to pay it 100% down, but you're going to free up enough that you're going to be able to then borrow from your line of credit again to put into your Infinite Bank, and borrow from your Infinite Bank back to pay down your line of credit. And what we end up with is, at the end of this, your full policy premium is paid for. You have loans in your Infinite Bank, and your line of credit is mostly paid off. Now, you're going to practice dynamic banking until it is paid off, and you're ready to do it again the next year when your premium comes due. You're going to repeat this every policy period when your premiums are due, knowing that with that line of credit, you're always going to be able to make that full policy premium. The thing that I like about this is that doing it in this manner, when you have a line of credit that you can pull from to make those policy premiums, it makes it a heck of a lot easier to sign up for the really big annual premiums that the infinite banking system requires. And you can take advantage of all the cash flow that ends up running through your accounts, all of the income that comes in. This is the way to make it so that you get the highest death benefit, and you have that ability to funnel as much of your income through it as possible. None of this is probably new to a lot of you folks. So let's go into the actual numbers, because I think that's what you came here for. So let's look at what we have here. This column is the balance for the line of credit as we utilize it to fund an infinite banking policy. This column is where we monitor which direction our transfers are going and how much as we go in and out of the infinite banking and the line of credit. This column is your infinite banking policy. We're going to figure a $40,000 a year MEC limit. That means you can deposit up to $40,000 a year without turning this into a modified endowment contract and all the tax consequences that come with that. Notice the line of credit is quite a bit smaller than your annual premiums. In this column, we have approximate cash value after each deposit and as we move our money. We track the loan values in this column, and in this column we talk about the loan interest that gets paid. Interesting thing to note is when you do borrow from your infinite bank policies, when you borrow against your life insurance, you prepay the interest. So we know exactly what the interest is going to be for the next year on whatever amount of money that you just borrowed. So we total all of this up, okay? What you'll see is in the first year, all of this prepaid interest. And then when we get to the second year, we've got annual interest on the prior balance. So that takes this total from the prior year, figures out how much interest the company would charge you. And for everything we borrowed during that year, we're going to have the prepaid interest, just like we did in the first year. So you're going to see that repeat. In year one, we start off, we have zero balances all over the place, okay? Our goal is to put $40,000 into the infinite banking policy as quickly as we can. In order to have the illustration match performance as close as possible, you need to get all of your paid up additions in within the first 60 days of these policies. So right here, we've got a $15,000 line of credit. We're going to use all $15,000 of that line of credit. Some of you may have been working with someone who may suggest that you don't max out your line of credit. But the reason in this case that we're going to use all of it is because we're going to get it back almost right away. Within 3 to 10 days, you can usually get access to the funds that you just put into it. So if an emergency comes up, you just have a few days and you'll have money back to your line of credit and your balance will be available. So in this case, we got $15,000. We're going to put all $15,000 into your infinite banking policy. So now you can see here, these are our premium payments we're tracking. We paid $15,000 towards our premium. Our cash value is going to end up being probably somewhere around $11,000. Reason being, this first payment is going to make all of the cost of insurance payments for the year. So you're going to take the biggest hit. So you're going to take the biggest hit on this first payment. You'll see it reduces drastically when we get to the payments after that. So here we have your loan value is currently 0, but we put 11,000 in there. We want to pull out as much as we can. Since we have to prepay our interest, we're going to prepay about $500 in interest, which means we can pull out about $10,500. So our loan value, we're going to have a loan value of $11,000, which includes that interest. Our cash value drops down to 0, and you get $10,500 back into your line of credit, bringing the line of credit balance down to $4,500. We have a $4,500 balance on our line of credit. We are going to then bring it back up to $15,000 by taking $10,500 out and putting it right back into our premium payments. So now our premium payments, we've got $25,500 into it. Our cash value is going to drop down a bit less this time because we paid for most all of the insurance costs here. There is a little bit of an insurance cost with each deposit that you make because you are buying paid up additions at this point. So our cash value is going to be lower than what we put into it. Typically by about 5%. Depends on which company you're using. Some companies charge more. But we have our loan value of $11,000, and immediately when we see that that cash value is available, we're going to pull it out and pay back that line of credit. So in this case, we've got another about $500 worth of prepaid interest. So we're going to put $9,000 back into the line of credit. Our loan value goes up to $20,500, and our line of credit is now paid down to $6,000. We're going to go up again, max it out, pull out as much as we can, put that $9,000 back into your premium payments, which brings us up to $34,500 in premium payments. We're almost to our MEC limit, but we're going to have to do this one more time. Cash value ends up around $8,100. We're going to borrow that again. Clearly, the prepaid interest is not still going to be $500. It will probably be lower, but we're just using hypotheticals for illustration purposes. So $28,500 is our new loan balance. We're going to pay $7,500 into the line of credit. Now our line of credit balance is $7,500. Now, we can't deposit more into this account than our MEC limit. So instead of going back up to $15,000, we only have $5,500 left until we MEC out. So we're going to borrow from the line of credit $5,500. So it brings our balance to $13,000. Make our premium payment, and our MEC limit is reached. Our cash value is going to be about $5,200, and we're going to be able to borrow about $5,000 of that back out, bringing us at the end of this. It'll probably take about 30 days to do all of this transferring back and forth, I would guess. Depends on how quick your insurance company allows you to make these transactions. But let's figure 30 to 40 days to do all this. Your balance is now $8,000 on your line of credit. Your balance in your policy, $33,200. And that includes all of the prepaid interest that we've made for the year. At this point, you have not put any of your own money into this life insurance policy, into setting up this infinite bank. You haven't put any of your own money into it except for a little bit of interest that you've had to pay. Now, you've likely been practicing dynamic banking, so these numbers aren't going to be exactly the same. You probably are able to pay this a little bit quicker because this balance is going to be dropping as you're doing your paycheck parking. But for illustrative purposes, I wanted to show you how this would work, assuming no extra payments go in, none of your own money, except for in the first 2 years, you have balance left over on your line of credit. The rest of this illustration that I'm showing you here is going to be just using the line of credit and the infinite banking policy. So, $8,000 left on your line of credit. You're going to need to practice your dynamic banking, get that paid down before year 2 comes along. Now, you don't have to get it paid down, but it makes it easier if you can start fresh and start putting in the full line of credit limit again, starting in year 2. Our balance on year 2, we're at 0. 15,000 into your infinite banking concept, 12,800 coming out, 12,800 going back into your infinite banking policy, 11,400 coming out, 11,400 going back in, and 10,200 going into the line of credit, 800 going back out into the infinite bank policy. This gets us to our MEC limit, and 680 will be able to pull back out into the line of credit, leaving us with a balance this year of 4,920, approximately. You're going to see a big difference from the first 2 years as we get into the policy now, because our policy is going to be growing. And because of that growth that happens in the background, despite all the borrowing we've done against it, we're going to get dividends that at the end of each policy year will build our cash value. So what you see in year 3 and beyond, we're going to be able to use that same line of credit of 15,000, and it's only going to take 3 transfers. Our first transfer for 15,000, and because of the dividend payments and the cash value growth that our policy experiences, we're going to have about $6,000 in there. So when we put our 15,000 in there, remember this is the first deposit of the year. That's where all the insurance costs come out of, so it reduces. But when we add that 6,000 to it, we end up about 19,500, and we're able to borrow all 15,000 back out to pay back that line of credit, which means we've got 15,000 to put back into the policy. And again, we still have enough cash value. We can borrow all 15,000 back out to the line of credit. And then we have 10,000 available to put into and max out our premium payments for this year. MEC limit reached with 3 deposits. Okay. Now over here, we've got our interest charges. This is our interest charge from all this year, the previous year, and remember we're paying the prepaid interest on all these loans that we're pulling out as we go along. So you're going to see the same thing happen in years 4, 5, 6, and 7. 15,000 going in, 15,000 coming out. 15 going in, 15 going out, 10 going in, 10 going out. Okay, so in this scenario, the reason I wanted to illustrate this scenario for you is so that you can see, without using much of your own money, at the beginning you're going to have to use some of your own money because the line of credit has to get paid down in years 1 and 2. So $13,000 of your own money that you paid back using your dynamic banking method throughout the year before your next premium is due, without putting any more of your own money than that $13,000. By the end of the 7th year, you're going to have about a $41,000 balance in cash value that's available. You put $13,000 of your own money in, everything else was borrowed. There's still a big loan out here in your policy, but you do have cash value in here that's available for you however you need to use it. Remember, you didn't do anything to help this along except in those first 2 years. Now, if you have a higher line of credit than $15,000 and you do a $40,000 annual premium, you're going to be able to get away without doing any cash out of pocket in those first 2 years. You just need a higher line of credit balance compared to your premium payment. So these are definitely things to take into consideration if you want to do something set up like this. But you guys are smarter than that. You don't want the debt. You practice dynamic banking in your life, and you just want to use something like this in order to maximize your cash flow. So let's look at what happens if we do a little bit of dynamic banking each year in between policy premium due. Everything else is going to be considered to be the same, except we're just going to do some dynamic banking after those first 30 or 40 days so that we can throw a chunk at this loan value. Okay, and we're going to do that on this sheet. So if we take a look here on this sheet, we still have the same line of credit. We're going to go through the fund transfers, and you're going to see a big difference after the first year. Okay, everything's going to look really similar in the first year, except right here, that $6,000 chunk goes into your infinite bank policy. It pays down your loan by $6,000, and that money turns into cash value. Okay, so that's what happens when we pay back our loans. It works just like your checking account or a savings account. Okay, every dollar you put in there to pay back your loans is going to be available to pull back out again should you need it. It works just like a line of credit in this regard, except you're working on the positive side of the balance sheet. Now, the advantage of paying that $6,000 off is we're not going to have that annual loan interest on this side, but we're still going to qualify for the dividend payments that the policy is generating. So we're basically just sloughing off this interest cost, which is a drag on the policy performance. Now you'll see in year 2, because we paid that $6,000 back, we now have a higher balance available. So when we put our $15,000 in, we can actually pull $15,000 out right away. This allows us to pay into this just like we did in years 3 through 7 in the previous example. Now, take a look here. We got another chunk, the end of year 2, going into the infinite bank. That's going to pay our loan back by $6,000. Cash value goes up. And we're going to do the same thing in year 3, at the end of year 2, beginning of year 3, end of year 3, end of year 4, end of year 5, and end of year 6, and end of year 7. So, by going through this method, what we see is a substantially lower loan balance at the end of year 7, and about $88,000, almost $89,000 in cash value. Now that's a pretty big difference from what we did in the first scenario. In the first scenario, we paid $13,000 out, and we had about $40,000 in cash value available. And in this scenario, we've been throwing chunks at it using our normal dynamic banking method to free up some cash so that you can do a chunk each year. We only paid $8,000 that first year for the line of credit. And then we managed to do chunks of $6,000 once a year for the next 7 years. And we end up with about $89,000 in cash value. Now, as you can see, this is not a type of get-rich-quick scheme. We're kind of creating a little bit of money out of nothing, okay? But the best way to utilize these policies is as an infinite bank, to get the commercial bank out of your pocket, right? So if we can't get rich quick on this, why are we doing this? Where is the advantages of going through this method? This is about cash flow. This is how we maximize our cash flow. That doesn't mean we're going to see 200% returns. What you see in an infinite banking policy is you see a 4 to 6% return on your money over the long term. Now, the more we go through this, the better the numbers get. But if you're only going to do it for 2 or 3 years, skip it. And this isn't going to be for you. This is long term. It's just like starting a business. And each business is going to run more and more efficiently. And it's going to be able to generate more and more returns for you. But let's quickly go over the advantages of this. Number one, when you switch to the infinite banking method, you get freedom from the banks. You don't have to ask to borrow money. You don't need to provide credit. You don't need their permission. For small business owners like myself, you don't have to bring in all of your financials every time you want to get a loan for something, which, as you know, is a pain in the ass. When you can just call up and say, hey, let me have some money, like you do with your lines of credit. When you can just ask for the money and it comes to you, it's such a freedom to be able to do that. That's what the infinite bank policy provides you. It also provides you guaranteed long-term growth. Like I said, we can expect a 4 to 6% return. 4% is guaranteed by contract. So when the rest of the country ends up in negative interest rate territory, like we're seeing overseas right now, there's other countries outside of the US who now have negative interest rates. That means when you put money into the bank, you have to pay them to hold your money. In this case, you're guaranteed 4% every single year. Now, what else do we get with that? It's life insurance, so we get a death benefit. And oftentimes, we get living benefits with that. In this case, for a $40,000 a year policy, you're probably going to get $1.3 million, $1.5 million, $1.8 million, somewhere around there, worth of death benefit on day one. That's huge. Where else are you going to be able to start creating money out of nothing? And if a tragic accident were to happen, you're able to leave your heirs with a nice chunk of change to remember you by. Or, in the case of a terminal illness, you have access to that right away. So that's what living benefits are. If you have $1.5 million living benefit, if you have a terminal illness that says you're going to pass away within the next 2 years, you have access to that full death benefit without actually having to die. So your family doesn't have to go bankrupt trying to pay hospital bills and you trying to do everything you can to survive. They're not going to be broke at the end of it. You'll be able to tap in and use some of those funds while you're still alive. It's awesome. It is a great benefit to have, and that's one of the advantages of funneling your money through your infinite banking policy. Because the side benefit of that is every time you put money into your policy, your death benefit goes up. 2 other benefits for doing it this way. You maximize your cash flow, just like when you use your lines of credit for dynamic banking. Getting every single dollar that flows through your hands into your policy gives you all of those other benefits, but it also gives you compounding growth on everything that you put into that policy. And of course, flexibility. These policies have tons of flexibility built into them. In this case, I went out 7 years on this example because at 7 years, you no longer have to make any premium payments if you don't want to. You can, but you don't have to. What we do is we have the option to turn this into a reduced paid up policy, which means no more premiums due, but you still have all the death benefit that you've bought to date, and you can still utilize that policy as your infinite banking policy, borrowing from it and repaying those loans. You just can't put any new premiums back into that policy. Make sense? That's the flexibility of these policies. They're really great, and if done correctly, if it's designed correctly and funded correctly at the beginning, you can't blow these policies up. So all of the guarantees that come along with it, along with the ability to turn off those premiums, means that you have the ultimate flexibility in utilizing these policies. So I hope that made sense to you folks. One thing I didn't get a chance to do is a spreadsheet showing what it looks like when your policy is smaller than the premium payments that are due. But I think you can see how that works right here. It would basically be just like the first payment. You put $15,000 in. If your premium payment is $15,000 for the year, you could pay it all in one shot. And then you got $11,000 paid back into your line of credit. You got $4,500 that's left over to pay down that line of credit. It ends up being a really easy way to increase what you can do comfortably with an infinite banking policy when setting it up so that you can absorb more of your income. Now, the ultimate goal, if you've been digging into infinite banking at all, the ultimate goal is to get all of your income every year flowing through your policy, and then you pull it out as you need it. That's really hard to do because, one, the insurance companies don't really like you to be able to do that. They limit how much death benefit you qualify for, and your death benefit limits how much you can put in as premium each year. So the challenge is you have to build that up over time. And this is one way to do that. If you can get your first policy started as soon as possible, preferably when you're younger, but if you're just getting around to it, the next best time is now. So you get your policy started, you get comfortable with as much as you can get into it, and then if you have the ability to start putting more into it, we can open up another policy. Or you can reapply with this policy to get it increased. But it's typically easier to just get a new policy. You can do that with the same carrier. You can do it with a different carrier. It just depends on your situation. And we can look at all that and figure out what's going to work out best for you. Now, my personal policy, the most recent one I got is with Mass Mutual. It's got a $13,000 annual premium, and I have a lot more than that available in my home equity line of credit that I use. So what I do is I pull out the $13,000 from my line of credit, I make my premium payment, and I was able to pull out immediately about $10,500, put it back into the line of credit, and then I just have $2,500 to pay down using dynamic banking. And because I use dynamic banking for a lot of other things as well, I just leave that $10,000 sitting in my infinite bank. And I'm going to continue to use the dynamic banking, and when I end up with some extra funds, after I pay down my home equity line of credit, then I will transfer that over and start paying down my policy loan. So for me, having that line of credit available means I don't have to worry any time of the year when one of my 4 policy premiums comes due. I can just pull from the line of credit, make that payment, and not have to worry about it. If I need the cash, I can just pull it right back out of those policies. So that's how it works for me. So if you have any questions, that's it for this one. The whole goal of this, again, is to be able to maximize your income by utilizing the dynamic banking method with the line of credit and paying those infinite banking premiums efficiently. I hope this helps you out. When I finish that project, I may do it before then. That project has really taken me a while to get all that video done. Well, I'm going to talk about in my next video how you can use your 401k or your IRA or basically any of your retirement accounts and fund your policy using your retirement accounts without actually withdrawing money from your retirement accounts. So stay tuned. And if you have any questions about any of this, leave them in the comment section below. I'm happy to help you out. If you want to chat about any of this, you can click the link up here, get to my phone call video, and sign up on my Calendly link so we can have a chat. I'm willing to give 20 minutes of my time to any of you folks on the phone. You just got to sign up at that Calendly link, and I'm happy to help you out any way that I can. Be sure, if you found value in this video, hit the like button, subscribe to the channel. I really appreciate you guys spending time with me today. Have a good one. Now go maximize your cash flow.